Price pushes higher, but the box still controls it. The session forms inside expanded memory. May 24th Asia session forms between April 21st U.S. session midpoint and May 21st U.S. session midpoint. It does not compress quietly. It expands wide. It overlaps old memory. That matters. When a session basis box expands, the trade gets more space. But the risk also gets wider. The candle can move more. The reaction can move deeper. The stop cannot be placed carelessly. A small box can trap with noise. A large box can trap with range. Both can hurt the account. May 24th Asia session forms with a large range. Price starts inside that expanded structure. Then price pushes higher. It breaks above May 22nd U.S. session upper boundary. That is the first important move. Price does not just touch the line. It crosses above it. It tries to create distance. Then price moves higher again. It reaches May 21st U.S. session upper boundary. Now the trade feels strong. But strength still needs holding. If price breaks above May 22nd U.S. upper boundary and immediately returns, the move is not ready. If price holds above the break and keeps distance, the long can work. That is where execution begins. Long entry line. May 24th Asia session upper boundary. Stop loss line. May 24th Asia session midpoint. Take profit line. May 22nd U.S. session upper boundary. Risk-reward ratio 1.58. The entry sits at May 24th Asia session upper boundary. Why there? Because the session expanded. The upper boundary becomes the first line, where buyers must prove control. If price cannot stay above that upper boundary, the breakout has no base. If price breaks above it and keeps holding, the long has structure. The trade does not start because the candle looks green. It starts because price leaves the expanded Asia box and does not immediately return. That is the difference. A green candle can be late. A held boundary can be entry. The stop sits at May 24th Asia session midpoint. That stop is important. In a wide session box, using the lower boundary as stop can make the risk too deep. The reward may not pay enough, so the midpoint becomes the damage line. If price breaks above the upper boundary, but returns to the midpoint, the breakout has lost control. The long is no longer clean. The move has returned to balance. That is where the position must be protected. Not because the midpoint is comfortable, because price has given back too much. The target sits at May 22nd U.S. session upper boundary. That target connects to recent memory. Price already broke above it later. But from the entry, that line is the first old boundary that must be reached and tested. A target should not be random. It should sit where price has a reason to react. May 22nd U.S. upper boundary gives that reason. Price reaches. It reacts. It either holds or fails. Now the problem. Risk-reward ratio is 1.58. It is usable, but it is not huge. That means execution must be clean. Entry cannot be late. Stop cannot be widened without reason. Target cannot be chased after price already moved. If the trader enters late, after the price already runs toward May 22nd U.S. upper boundary, the ratio weakens. If the trader widens the stop below the midpoint, the ratio weakens. If the trader moves the target higher without price earning distance, the trade becomes hope. So the long must be taken near the actual line. May 24th Asia upper boundary. not far above it. Now compare trader types. An aggressive trader may tighten the stop. The stop distance becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The long pays faster, but the cost is real. A tight stop can be touched by normal reaction. The structure may still be valid. The position may already be gone. That is the pain. You are right about direction, but you cannot collect. A conservative trader does the opposite. The stop is not too tight. The position size becomes smaller. The trade gets room. The chance of losing the position before the target decreases. But the stop distance is deeper. The reward must still pay. If the deeper stop makes the ratio too weak, the conservative answer can become no trade. That is real discipline. Not every valid idea deserves entry. A good-looking long can be skipped if risk does not deserve the reward. Now price continues. It breaks above May 22nd U.S. session upper boundary. It reaches May 21st U.S. session upper boundary. The target works. The trade has paid. Now the next question appears. Do we trail? Trailing is not automatic. A trail needs distance. A trail needs holding. A trail needs enough profit to protect. If price reaches the first target and stalls immediately, take the result. If price reaches the first target and keeps building distance, a trail can be considered. A useful trailing interval usually needs at least about 0.5 risk-reward unit of additional movement. Less than that often becomes noise. If you trail too early, you suffocate the position. If you trail too late, you give back too much. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot become too tight. If normal reaction touches it, the trail damages the trade. If the stop stays too far back, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last green candle. Partial profit can help. If price reaches the first target and reaction starts to speed up, protect more first. A conservative trader can take 60% first and leave 40% for continuation. If price holds the target and keeps distance, an aggressive trader can leave more open. An aggressive trader can take 40% first and leave 60% for continuation. If there are two trailing stages, the same rule continues. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the percentages do not create the trade. They only manage a trade that already has structure. May 24th Asia gives the first lesson. The session expands. The range gets wide. The long can work, but risk gets heavier. The entry must be near May 24th Asia upper boundary. The stop must protect the idea at May 24th Asia midpoint. The target must connect to May 22nd U.S. upper boundary. Risk-reward ratio 1.58. Price moves higher. But the box still controls the decision. Price compresses again, but compression does not give permission. The session forms inside old memory. May 25th U.S. session forms near May 22nd U.S. session midpoint. It compresses to about 30%. It overlaps there. That matters. A 30% compression is tight. The box is small. The decision can come fast. But a small box can also create false confidence. A trader sees the tight structure. A trader wants quick entry. But quick does not mean clean. May 25th U.S. session first pushes higher. It reaches April 27th U.S. session lower boundary. That level matters. It is older memory. It is not just a nearby line. It is a place where price has reacted before. Price reaches it. It tests. It cannot build clean freedom. Then price turns down. It breaks below May 22nd U.S. session upper boundary. Then price returns into May 25th U.S. session box. Now the market is showing both sides. It pushed up. It failed to stay free. It dropped back. It returned into the compressed structure. That is the pressure. Now the long setup must be read carefully. Long entry line. May 21st U.S. session upper boundary. That line overlaps. May 25th U.S. session midpoint. Stop loss line. May 22nd U.S. session lower boundary. Take profit line. April 27th U.S. session lower boundary. Risk-reward ratio 2.07. This long does not come from chasing the first push to April 27th memory. That would be late. The long comes from May 21st U.S. upper boundary, overlapping the May 25th U.S. midpoint. That overlap matters. When the session midpoint and older memory overlap, the line gains weight. Price must decide there. If price holds above it, buyers can attempt another push toward April 27th U.S. lower boundary. If price loses it, the long has no base. So the entry is not the high. The entry is the line, where price must hold before the high. May 21st U.S. upper boundary. May 25th U.S. midpoint. Same zone. That is the execution area. The stop sits at May 22nd U.S. session lower boundary. Why there? Because the long is using the May 22nd and May 21st memory stack. If price falls below May 22nd U.S. lower boundary, the overlapped midpoint support has failed. The compressed session can no longer protect the trade. The long has lost its base. So the stop belongs under that memory. Not at a random candle low. Not at a place that feels comfortable. At the line where the idea breaks. If price reaches that stop, the long is no longer the same trade. The target sits at April 27th U.S. session lower boundary. That is where price already tested. It is the next old memory above. If price holds the entry zone and builds distance, April 27th U.S. lower boundary becomes the clean target. Risk-reward ratio 2.07. Now this is different from the first setup. The first long had 1.58. This one has 2.07. The ratio is better. But the environment is not automatically easier. Why? Because price already tested April 27th U.S. lower boundary and failed to stay free. That failure matters. A second attempt can work, but it must show stronger holding. If price enters from the midpoint and cannot move away, do not force it. If price holds the midpoint and reaction becomes slower, the long can build. If price reaches April 27th again and stalls, take the trade seriously. Do not expect unlimited continuation. Now the bearish candle matters. After the push, price falls back below May 22nd U.S. upper boundary. The candle moves with force. It returns into the session box. That is a warning. When a candle breaks back into the box, with more range than the basis box itself, the market is not calm. The move can be powerful. It can also make late entries dangerous. That is why the long must be taken only near the entry line, not after price runs, not after the target is close, not after the chart already looks obvious. Now, aggressive trader and conservative trader must choose differently. An aggressive trader may place a tighter stop. The stop distance becomes smaller. Position size becomes larger. The ratio becomes attractive. Sometimes price never touches the tight stop. The trade pays. But the danger is simple. A tight stop can be hit by normal rotation, especially inside a 30% compressed box. The idea can still be right, but the position can disappear. A conservative trader allows more room. The stop goes under stronger memory. The size becomes smaller. The trade survives more noise. But the reward must still justify the risk. If the wider stop weakens the ratio too much, skip the trade. Conservative trading is not only wider stops. Sometimes it is no trade. Now trailing. If price reaches the first target and keeps holding, the target can move, but the trail must be earned. Do not trail because you want more. Trail because price creates more. Use distance. A practical trailing interval should wait for about 0.5 risk-reward unit or more. That gives the position room. It reduces noise. When you move the target, move the stop. If the stop stays behind, profit stays exposed. If the stop comes too close, normal reaction removes the trade. So again, the stop follows structure. Partial profit helps when the reaction changes. If price reaches the target and reaction speeds up, a conservative trader protects more first. 60% first. 40% left for continuation. If price keeps holding and distance grows, an aggressive trader can leave more open. 40% first. 60% for continuation. For two stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But again, numbers do not replace structure. They only manage structure. Now connect the May 25th U.S. setup. The session forms near May 22nd U.S. midpoint. It compresses to 30%. It pushes toward April 27th U.S. lower boundary. It fails to stay free. It drops back below May 22nd U.S. upper boundary. It returns into the compressed box. The long can still exist, but only if May 21st U.S. upper boundary and May 25th U.S. midpoint hold. Entry: May 21st U.S. upper boundary. Stop: May 22nd U.S. lower boundary. Target: April 27th U.S. lower boundary. Risk-reward ratio: 2.07. The setup is not a chase. It is a test of overlap. The midpoint must hold. Old memory must support. Distance must open. If price only rotates, no trade. If price holds and moves away, the long becomes active. That is the lesson of the day. May 24th, Asia gives a wide box. May 25th, US gives a tight box. One expands. One compresses. Both require the same rule. Price reaches. It reacts. It holds or fails. Then the trader asks one more thing. Does the risk deserve the reward?